What if I told you that artificial intelligence could potentially manage your investments better than a professional fund manager? Would you believe me? Well, that's exactly what I decided to test. For 30 days, I handed over $1,000 of my own money to an AI investing platform and gave it complete control. No human intervention, no emotional decisions, just pure algorithm-driven investing. Welcome back to Capital Course, where we explore the future of finance. I'm your host, and today's experiment might just change how you think about your investment strategy forever. Before we dive in, hit that subscribe button and notification bell to join our financial community, and never miss our latest market insights. Now, I didn't just pick any random AI investing tool. After researching dozens of platforms, I narrowed it down to 3 contenders: Wealthfront, M1 Finance's Intelligent Portfolios, and the newer player in the field, Composer. I ultimately chose Composer for this experiment because of its unique approach to algorithmic investing strategies. Unlike many robo-advisors that use fixed allocation models, Composer allows for more dynamic strategy building and backtesting. Plus, it offered the most transparent AI decision-making process. Setting up was surprisingly straightforward. After creating my account and completing the verification process, I transferred exactly $1,000 into the platform. Then came the critical part, selecting my investment parameters. I gave the AI 3 main directives: focus on a balanced approach with moderate risk tolerance, no specific sector restrictions, full market access, prioritize a mixture of growth and value investments. I specifically chose not to restrict the AI to certain sectors or investment vehicles. It had access to ETFs, individual stocks, bonds, and even some alternative assets. The goal was to see what the AI would prioritize without my biases getting in the way. The first week was fascinating. The AI immediately diversified my $1,000 across multiple asset classes, but not in the way I expected. Instead of going heavy on tech stocks like many human investors might in 2025, the AI allocated 42% to broad market ETFs, 18% to sector-specific ETFs, primarily healthcare and consumer staples, 15% to individual large-cap stocks, 10% to bond ETFs, 8% to international markets, and 7% to a gold ETF. What immediately surprised me was the relatively conservative approach. The AI seemed to prioritize diversification over concentrated bets, which honestly makes statistical sense but differs from how many retail investors approach the market. By the end of week 1, my portfolio was down 0.8%. Not great, but not terrible considering the broader market was down 1.2% that week. Week 2 is when things got interesting. The AI began making adjustments based on market movements and news sentiment analysis. This is where its computational advantage over human investors became apparent. When quarterly earnings reports dropped for several major companies, the AI reacted within minutes, not hours or days like many retail investors. It trimmed positions in companies with disappointing guidance and increased exposure to sectors showing strength. One particular move stood out. The AI increased my exposure to energy ETFs by 4% just hours before a major oil supply report was released. That specific position gained 3.2% in the following 2 days. By the end of week 2, my portfolio had recovered and was now up 1.7% overall. The S&P 500 was up 0.9% over the same period. Week 3 brought significant market volatility following unexpected inflation data and concerns about interest rate hikes. This is typically when human emotions can lead to poor investment decisions, panic selling or irrational buying. The AI didn't flinch. Instead, it methodically rebalanced the portfolio, taking advantage of price dislocations. It increased my bond allocation by 5% as a defensive move, but simultaneously added to selective growth positions that had been oversold. One particularly impressive move. While everyone was panic-selling tech stocks, the AI selectively purchased shares in a cloud computing ETF that had dropped 7% in 2 days. That position rebounded 4.8% by week's end. My portfolio finished week 3 down 0.5% while the broader market was down 2.3%. The AI's unemotional approach had preserved capital during volatility, exactly what you want from an investment manager. The final week demonstrated what I believe is the true advantage of AI investing pattern recognition across massive datasets that humans simply cannot process effectively. The AI detected subtle correlations between certain economic indicators and specific sector performances, then adjusted my portfolio accordingly. It increased exposure to consumer discretionary stocks ahead of positive retail sales data, and trimmed positions in rate-sensitive sectors. By the end of our 30-day experiment, my $1,000 had grown to $1,036.42, a return of 3.64%. For comparison, the S&P 500 returned 1.8% over the same period, and the average retail investor's self-directed account gained just 0.7% according to recent research. Let's break down what made the AI approach effective. Emotionless decision-making. The AI never panicked during volatility or chased momentum without statistical backing. Processing speed. The AI analyzed earnings reports, economic data, and news sentiment in real time, allowing it to react faster than human investors. Pattern recognition. By analyzing thousands of historical market scenarios, the AI identified subtle correlations that human investors might miss. Consistent execution. The AI strictly followed its own statistical models without second-guessing itself or changing strategies mid-course. Interestingly, the AI made a total of 27 trades over the 30-day period, far more active than a typical buy-and-hold investor, but less frenetic than day traders. Each trade was calculated based on probability models, not emotional reactions. Now I need to be transparent about the limitations I observed. Tax inefficiency. The AI didn't consider tax implications of frequent trading, which could be problematic in taxable accounts over longer periods. Fee sensitivity. My experiment didn't include trading commissions, but, frequent rebalancing could eat into returns on platforms with per-trade fees.
Breaking news.
Black box decisions. Despite Composer's transparency, some AI decisions weren't intuitively obvious, which might be, uncomfortable for investors who want to understand every move. Limited contextual awareness. The AI couldn't factor in personal financial circumstances or goals beyond the parameters I initially set. No human intuition. During major geopolitical events, human judgment sometimes provides context that algorithms might miss. So, would I trust an AI with my investments long-term? The data suggests it's worth serious consideration. The 3.64% return over 30 days translates to roughly 43% annualized, though I should emphasize that's not a realistic expectation for sustained performance. Markets are unpredictable, and past performance doesn't guarantee future results. However, the AI's ability to maintain discipline during volatility and identify opportunities through data analysis gives it significant advantages over emotional human investors. For most investors, I believe a hybrid approach may be optimal, using AI for statistical analysis and execution while maintaining human oversight for long-term planning and contextual decision-making. Based on this experiment, I'm planning to continue testing AI investing strategies with a larger allocation and longer time frame. In our next video, I'll be examining 5 AI investing tools that beat the market in 2025 to help you find the right platform for your needs. I'm also considering comparing different AI approaches head-to-head: conservative versus aggressive, technical versus fundamental, and short-term versus long-term strategies. If you found this experiment valuable, make sure to subscribe to Capital Course for more insights at the intersection of finance and technology. Hit that like button if you want to see more AI investing content, and share your thoughts in the comments. Have you tried AI investing tools? What was your experience? Let me know below. And for our community poll, would you trust an AI to manage your investments? Vote now, and let's discuss in the comments. Thanks for watching, and remember, stay curious, stay informed, and keep building your financial future with Capital Course.